right. Welcome to the Millionacres Hour. And we're going to talk about home builders this hour. And when I talked to Jason about setting up this, yeah, they're all doing great. And that made me think about how you look at companies when they're in a situation when kind of the whole group is doing really well due to market conditions. Because I was thinking about it, I think that sometimes when a company is doing well because of that, you almost have to watch it more carefully. What do you think about
Right.
that?
I think so, especially when you're talking about home builders and this kind of business that is very cyclical, right?
Yeah.
And in general, they tend to have more leveraged balance sheets, right? So when you have companies that are in a highly cyclical industry and also have highly leveraged balance sheets and don't tend to carry a lot of cash, and their working capital amounts can be pretty small. If the cycle turns, when it inevitably turns, these great results can get really ugly really fast. And you can kind of be, it's the Warren Buffett quote about, when the tide goes out, you find out who's swimming naked, right?
Exactly. I think that's one of the things that I sort of heard on some of the earnings calls too, was because companies like D.R. Horton, like LGI Homes, they're all saying like record quarter or second highest quarter. But in all of that, I also heard that just little whisper of caution and that knowledge that it can't last forever. We're in this odd cycle. You and I have both been following this. This is the first year I was listening to a conversation with Lawrence Yun, the economist from NAR, the other day, and he was saying that this may be the first year that we're almost to the level of historical home buying. So we've been below the home building. We've been below that level
Building
for what, a
seven,
decade?
8. Yeah. I'd say since 2010, at least, probably 2009.
Yeah.
Yeah.
So we're just almost getting to the level where we're building enough historically, which doesn't mean necessarily that we're building enough for the coming generations and household formation, because we're not when it comes to that.
Yeah, I mean, we're building as many as we should in an average year, is basically what
Right.
he's saying.
Yes.
That doesn't mean we're caught up, because we're still, what, 3.5, 4, maybe 5 million houses short,
Right.
right? So I mean, there's this major gap, and it's the pressure. You can see some of that pressure on some of these companies' numbers, and we'll get into the numbers later. But I just want to tease one, right, that I think really points to it a lot. Is like Meritage Homes, for the past 4 or 5 years, has been going through this transition away from custom homes. Was really more than half their business. You go back 5 years ago,
Mm-hmm.
and now it's like 25% of their business. So during that transition, you saw their average sales price falling. You look at their orders now, it's going the other way, right? Even though they're selling more and more, still selling more and more starter homes. So that right there is the number to me that talks about the pressure on the market right now.
Well, that is an interesting point, because that makes me think about what was happening before the pandemic, right? Before the pandemic, we saw a lot of these home builders saying, okay, not a great market for us. We're priced a little high. We're going to start working on reducing our square footage. We're going to start aiming more at the starter home market.
Mm-hmm.
We
Mm-hmm.
understand that we should, look at cheaper areas. And then came this time when they kind of couldn't do anything wrong. And
Yeah.
so some of them are
Yeah.
continuing with that plan. Meritage is one that, like you said, are moving away from custom. LGI Homes, I know, doesn't do any custom at all.
Mm-mm.
But we're starting to see where they almost don't have to do that pivot anymore and go toward the starter market, because homes are selling across the board. I mean, one of the things I found interesting was Toll Brothers, which is, at the upper high end of
Right. Right.
new home builders. They had a phenomenal quarter,
Mm-hmm.
partly because there's plenty of people who made a lot of money in the stock market who are ready to buy and looking for so much more space right now.
Right. Right. Or didn't spend any of that disposable income last year,
Mm,
and their savings rate skyrocketed, right? It's
yeah.
enormous. And I remember we first saw Deidre talking to you here, I think it was in the Million Acres Hour, actually, about this time a year ago, when we started hearing some of the data about luxury home sales, like that they
Hmm.
were up, I don't know, like 60 or 70, like some crazy high percentage point. And here we are a year later, and you have a Toll Brothers that's still doing well, right? It's definitely a case of that rising tide lifts all boats. But I think people just don't. I think the biggest thing is I want to emphasize it's not just a rising tide. It's raining after a decade of drought,
Yes.
right?
Yes, but
But
because things because things can always change. And I think that is the risk of the rising tide. One of the things I wanted to talk about today with home builders is when a sector is booming, how do you think about it? So, okay, everything in this particular sector is doing well right now. So is that a thing where you try to pick a winning horse, you try to pick two with some different strategies, you try to try to figure out how to protect yourself against the future. And I think that is the really interesting part of this, is because yes, just about every home builder had a great quarter. Their balance sheets are looking great, but you also kind of want to dive into the individual strategies. And I think one of the things that I'm watching as I look at home builders is what are they doing besides just home building, the traditional method of building homes directly for sellers? Because I think a lot of them are starting to do some really interesting things.
yeah, I agree. And we've definitely seen like a lot more it seems like a lot more of these home builders are kind of focused on like the balance sheet discipline, using more options, a little bit less just buying the lots. But still you look at the leverage ratios and they're still, there's a lot to be cognizant of as an investor. But yeah, let's hit this. Let's talk about, some of these key things that you're watching for.
Well, let's talk about options first and just explain what that is for the fools.
Yeah.
So the difference with home builders, you can do two things. You can either directly own lots, or you can have options to purchase lots, and it's sort of like you have the opportunity to buy those lots later. And so traditionally, you mostly saw home builders just buying lots.
Yep.
And then I think it was probably after the great financial crisis that you started to see this shift more toward the option strategy. NVR,
Like everybody's
for example,
done that, it seems
yeah.
like. Yeah. Yeah.
Yeah, I think NVR was like the first one, but then everyone has sort of gone toward that. And now I'm seeing some home builders look at what is a healthy ratio. Is it that 50% owning the lots, 50% options? Because when you go too far the other way, one of the things I think some of the home builders ran into is they couldn't get access fast enough, because all of a sudden they had to turn on the home building machine to capitalize on demand. If you've got options, you maybe aren't able to move quite as fast as if you own the lots out and you can just sort of, if the permits are there and everything is all ready to go, kind of immediately start building.
Right. I think it's interesting, right? You look at Horton, and we'll talk about Horton here too, but either directly or through 4-Star Group, I was reading through their transcripts, and this surprised me when I saw it. Horton only owns 24% of its lots. More than 3/4 of its lots are through purchase contracts, through options. And that really surprised me, that it was that substantial.
Yeah.
For that big of a player, I mean, theirs is unique, right? Because they basically have first right of refusal.
Well, right. And that was one thing that was interesting on their call too, was talking about that relationship with 4-Star, which is essentially they own, I think it's 60% of 4-Star, I believe, which is
yeah.
And then 4-Star owns
4-Star's a lot
lots.
developer. For anybody that doesn't know, that's basically what they do, is they buy lots and they prep them.
Yeah.
I mean, that strategy it's become basically the de facto strategy in the market. Right. And it's one of those things too, that I think it's the risk is you have more companies that see the opportunity to jump in the middle, right, and acquire and be like a mini 4-Star in an area. And so now here's the bottom line. You use that strategy as a home builder, there's a cost to using it. And you talked about that, right? One cost is how quickly you can tap land, right? How quickly can you, if you need to accelerate development of that land and you don't own it, it's going to cost more to do that in some way. Either if through you have a purchase contract and you're going to have to, accelerate access to capital, that costs money,
Right.
right? The seller of the land, maybe they're going to want more, right, to move forward quickly. If you don't already have terms built in to allow you to do that, there could be an additional cost. Or simply, guess what? Somebody else wants to develop it too, and you don't have an option for the land. You're going to pay more, right? And what's the biggest issue right now? Everything else costs more. So you have to pass that cost along. So, we've seen margins. We'll talk about this too, right? We've seen margins have held up, but that's one of the things I know you're watching for is, are we going to run into a wall of cost where passing those costs along is just not going to be a guarantee.
Well, I think the other thing that when thinking about options and land is the impact of remote work is part of what changed this, because one of the reasons that home builders started to look at options is options give you pivot power, right? So you can, okay, things aren't going so well in California. We've got options over here. We can just keep moving and shuffling around a little bit. That's a great thing to have.
Absolutely.
But when you've got remote work and kind of almost everywhere seems like an okay place to build, then it's not as powerful a strategy. And I think that's kind of what happened, was that some of those exurbs just really, really, became more attractive to people. And I think that last year we thought about this as remote work as a temporary thing. Earlier this year, we thought about it still like, okay, we're all going back to the office, September, October. The Delta variant, the ones that are coming after that, all of that is changing this from this was a cycle to maybe this is a long-term way that things are going to be. And we're all going to need room for home offices because we're not going to go back to the office 5 days a week. And so that just changes the whole, kind of changes the whole map of the country in a lot of ways.
Yeah, it does. And that's a thing that's, gets back to one of those, how do you think about this kind of an industry in this space? Is because this isn't Zoom video communications or some software company that has massive operating leverage, and their incremental margins are like 90-something% for new sales at some point. There are real fixed hard costs and things like access to skilled labor in the market, right? That all, those implications are the add levels of complexity. And it's one of the reasons, and, I'll talk a little bit more about this a little bit later once we kind of get through earnings, but this is one thing that I think is easy to, and sometimes as investors, especially if we try and find, think about market being at all-time highs, we think about the price to sales ratios of some of these great hyper growth companies. And then you look at like Pulte Group, Lennar, Meritage Homes, LGI Homes. The most expensive of those stocks on a trailing basis is LGI Homes, and it trades for 9.1 times earnings. 9.1 times earnings, right? Not sales.
Right.
But the market values these because of that leverage, because of the cyclical risk, and because of all of those fundamental challenges of operating in that business and the risks that things can change very, very, very quickly. Right?
Yeah. Absolutely. We've got a question from Kelly about the combined with the cost of building materials. And so that was something that I wanted us to talk about. Earlier this year, we saw lumber up 400% year over year. We're not dealing with that now, thank goodness. But I think lumber prices are set to rise for a couple of reasons. One of which is the impact of the fires on the West Coast, and not just in the US, but the Vancouver area, where a lot of that, framing lumber comes from British Columbia. It's starting to get a little challenging. Some of the timber REITs were talking a little bit about that on their earnings calls of, that may end up changing those cycles. And it's not just lumber that we're dealing with. It's steel is going up. Cement has been up and down, and also the ongoing supply chain problems. One of the things that a lot of the home builders talked about was appliances, because so many appliances, it's really cool that your refrigerator talks, but it needs a chip.
Right.
So
Guess what? Yeah, it needs a
yeah,
semi. Yeah.
good luck getting one.
How happy are you about that talking refrigerator now? Right.
Right?
That's the
Right?
thing.
Like
It
it was
took,
all so cool. Like everyone sees it
right.
at CES and it's like, oh, this is great. Our refrigerators will
Mhm.
do all these things. Well,
Unintended consequences. Here we go. Here we
hmm
go. Yeah. Just anecdotally, we ordered a new dishwasher last year. Um, it took 5 months.
oh,
Well, about four, a little over four. It took but 4 months. Yeah. So it's all of those things, the implications are very real. They really are very real. Um, yeah.
yeah,
All right. What's next?
definitely. All right. So wanted to go through some things to watch. We talked just a little bit about lots. One of the things that I saw in the earnings from the different home builders that we are looking at is Sunbelt. I mean, obviously Sunbelt, I feel like I keep talking about the Sunbelt every time I'm, talking about real estate, but the migration trends are really long term. I hear so much now about the cost of doing business in California. I know you're in California. But the home builders are all saying the same thing, which is we want to be there, but we don't want to be there too much because it's too risky, it's too expensive, and they're starting to find that they can catch some of those same consumers that are going to different places.
Right.
I feel like I keep talking about Boise, Idaho
Mhm.
on these shows, but the inflow migration there is incredible. Obviously, Texas, Austin, places like
Mhm.
that,
Mhm.
Florida. But the other trend that I'm seeing too is a little bit of more these builders starting to look at some of the central states where prices for land might be a little cheaper. So mid-Atlantic, central, certain areas like around some of the larger cities in Ohio are starting to become appealing to some of these builders.
Yeah, and I think you see the same trend happening in the Midwestern college towns, right?
Yes,
Because they tend to have infrastructure in place. They tend to have good schools because college teachers want good schools, right? So the local public schools are pretty good. So they have a lot of those things. So it'll be interested to see if that trend does continue to expand across more of the middle of the country. And it could be enormous, right? I mean, it could be a huge economic uplift for a lot of areas that have suffered from brain drain, right? When they're best and brightest graduate from high school, they go off to college, and then they never go back to where they came from. So
right.
I think there are potential implications 10 or 20 years down the road that it could be incredible, right? This terrible, brutal crunch that has so many people. Like Hogfather, I see your comment in here being 28, just asking Deidre and I to tell you that yes, one day you'll be able to own a house, right? And I know it feels a little like this dystopia here for a lot of people. I get that. But I do think that there is the potential that with the remote work movement and all of those things happening, this could be the great rebalancing, right? I mean, it's possible. It's possible.
Well, yeah, Rich Barton, the CEO of Zillow, has called it, the unlocking of mobility. There's
Yeah.
been, and he was talking about that before that. But
Mhm.
given that the average time that people stay in a house when they buy a house has gone up dramatically over the last 10 years. It used to
Right.
be like you were supposed to stay in a house 5 to 7 years. It's now 7 to 10. And so that too has been something that's continued to happen. But there is that possibility that people might want to be more mobile. And so I think that's a factor to look at as well.
Yeah, I'm going to circle back to what you just touched on though, with people staying in their homes longer, right? Because we focused on home builders right now and how incredibly short supplied the housing market is, and the big, the gorilla in the corner, or is it an elephant in the corner? The gorilla in the room, whatever it is, it's big, right?
I think it's an elephant, but I know where
Yeah.
you're going.
Mixing the metaphors here, but the key, right, is existing inventory.
Yeah,
And I mean, we're still incredibly short supplied. And in terms of home sales every year, that existing stock is still the vast majority, right? It's still
right.
where most people find homes is existing homes. But baby boomers are not downsizing. Baby boomers are not, sure, a lot of them are relocating, right? To Sunbelt areas and that kind of stuff as they retire and look to lower their tax bill and get somewhere with better weather and that sort of thing. But they're buying big expensive houses. They're They're selling their big expensive house in California or New Jersey and buying a big expensive house in Florida or North Carolina. But a lot of them aren't. A lot of them just
A
are
lot of them are
not
aging in
doing it,
place.
right? That aging in place trend is big. It's big. And there's positive things about it, right? If you think about it from like just at a starting perspective, these people stay in the communities that they've established relationships, right? So less people becoming isolated, right, as they age, which is a big issue.
Yeah.
You have people being more active, right? Tend to have healthier, longer lives. So like there's a lot of positives from a demographic perspective, but it doesn't match up with what the housing experts were expecting to see for people our age, Deidre, and younger, who wanted to buy a house or were ready to move out of the starter house because now they got a couple kids and it's getting a little bit claustrophobic and we need more space. Mom and dad's they're not retiring to Florida now and making that 5-bedroom house available.
Well, yeah, I forget when it was that WSJ had that article where they had the term silver tsunami. And so I just sort of stuck on that silver tsunami. It hasn't come. And talking about the aging in place, one of the things that I've been studying too is that has led to a remodeling boom really all across the country sort of consistently, is that there needs to be, people are thinking about aging in place differently. So they're figuring out, do they have to add different things for the stairs? Do they have to, maybe they move the master bedroom down to the first floor? There's all sorts of things that people are thinking about when they think about how to use their space differently. So the other thing is,
I think you just made a case to buy Home Depot. I mean, that's basically what, or Lowe's.
Hey, you cannot go wrong with Home Depot or Lowe's, at least right now.
No
but
kidding.
There's also this thing of, are these homes that are for, that come up for sale going to be in the places that people want? The idea before the pandemic was probably not, because nobody wants to live in the suburbs and everybody wants the city and everybody's going back to urban. That whole thesis has completely shifted. And going back to the home builders, that the fact that thesis has shifted is part of the reason that these home builders are having these great results, because they're not doing infill development. They're doing development outside of cities, and they're finding that if people only have to go into the office 2 days a week, they're fine with living 45 minutes out, from where they work.
Anecdotally, I'm going through exactly that. My wife is taking a promotion at work, and we're here in Southern California. She's taking a promotion at work, and we're moving. She's going to be working in Boston, and she's only going to have to go in, once or twice a week, or once or twice a day, once or twice a week, most weeks. But she needs to be there as part of the leadership team for that area, and all of her staff are going to be, going into that office, and they're all based there. But we've decided, we're going to live, 30, 45 minutes outside of the city. So and it's common, this same, anecdotally, it's our situation, but other professionals that April knows that are going through similar moves, it's the same thing. It's the same thing. So even though it's part of the remote work, there's a relocation that's still necessary. But our situation now, we live a mile from her office. We don't have to live a mile from her office anymore. And that substantially increases our ability to get a lot more, right? And a lot of people are seeing the same thing. They're looking for that. That's what they want. So, and the home builders are, they're racing to build houses in those places.
Well, and you brought up something else too, that desire for more too, because if you both are at home and she's only going to the office a couple days a week and you need a home office, that is changing floor plans. And we've seen a lot of that. The home builders have also talked about that, not just in terms of how they build, but also how they position homes, positioning one of the bedrooms as a home office or something like that, changing a little bit the floor plan so that the homes, so the bedrooms don't have, adjoining walls, getting a little more space in between, using hallways, things like that. So really, it's very interesting with home builders, because you've got this impact of some short-term trends or some trends that seem to be evolving. But when you're a home builder, you have to try to make decisions years in advance to some extent.
Right.
I mean, it'll take 4 to 6 months to build the house, but before that, you have permitting, you have to deliver really all of the plans and thinking about the materials you use and all of that well in advance.
This is
So you
not
have
just
to
running
try
the
to
line of
figure out.
code. And if it crashes it, you just remove the line of code and it's fine. Yeah.
Yeah, which is actually one of the reasons that it's both great to invest in home builders because, there's that stability, but it's also risky because, yeah, there's not that ability to pivot the way that they'd like to.
Yeah, exactly. Exactly. But at the end of the day, I think it's one of those things where we're adaptable as a species, right? That's the reason we've accomplished everything we have as the human animal. And we're really good at adapting spaces to work. But whether you've got kids or a spouse or you're single, at some point you've probably done a lot of Zoom work in your kitchen over the past year and a half. You don't want to do that anymore, right?
Yeah.
Right. It's about finding a space that is for work and is not also the space that you sleep or the space that you eat or the space that you entertain guests, that it is a space just to work, right? I think that's the key. And it's that more, right? Needing that little bit more.
Yeah, that's a pretty profound shift because if you're going to be working from home for 6 months, yeah, you can do it at the kitchen table. If you're going to be working at home for the foreseeable future, no, you don't want to, and it's not good for you psychologically.
No.
So let's take a look at some of the numbers. I want to dive into Meritage. I know it's one of your favorites, and the numbers were just amazing. But we are seeing a little bit of a decrease in orders, which I thought was interesting.
Yeah.
I think some of that might be price driven. What are you thinking?
It's price driven, but actually it's also intentional. On the earnings call, they talked a little bit about it. They're trying to ramp up the number of course the word just fell out of my brain. Individual developments. What's the word I'm looking for here?
I don't know. Sorry.
The communities.
Communities.
Yeah.
Oh, okay.
Yeah. Yeah. So they're trying to ramp up the number of communities that they have open that are actively selling. But the past 6 months, 9 months really has been so insanely busy. They sold through a lot more than they expected to sell through. So they intentionally tried to throttle orders in this last quarter to maintain some inventory as they transition. But it's a little bit intentional, but a lot of it is, I agree. I think if you look at their order price, jump back up to like $430,000 or $430,000 in the, at the end of the quarter. And they were a 420, was it 420? Yeah. Average selling price on orders, was above $420,000. And they had been running like in the 380s, their actual closings have been in the 380s. So definitely, some price pressure that's impacting these guys.
Yeah, well, that's an interesting fact too, because their starter homes are now more expensive. I mean, it's all just kind of been out of control, but they, one of the things they talk about, the 23% year-over-year increase in home closing revenue. So that got them to 1.3 billion for the second quarter of 2021. So, it's really, they've got that problem where they can't really make prices go down too much because at this point, they have to protect their margins too.
And they have been so far, right? We've seen their
Right.
margins, we go back, 3 or 4 years ago and margins were in the low 20s, 20, 21%. And this was, at the time, there were some challenges. It was kind of a few years after the housing crisis and the company had been struggling. And finally demand was recovering. And the problem back then was finding skilled labor. So labor costs were weighing on their margins. And it seems like a lot of that has been addressed over the past few years. And now we're dealing with all of the materials costs, right? And labor supply it's still short, right? But a lot of it is just, there's so much demand for it, right? But so far they've been able to hold those margins. I think they actually might've had, second or third highest gross margins on home closings that they've had in maybe ever, last quarter. But at some point, passing along higher costs, you're just going to hit a wall with that.
Yeah.
but so far they've surprisingly been able to do it. I want to call out their land inventory too, because their land inventory is up. So it was at 43,000 last year at the end of the quarter, and it was up to 63,000. So that's a 45%, 45% increase in their land supply. And if you look at their run rate of 3,000 houses, but at their growth rate, that's probably 6 years supply of land for these guys. Right. Yeah. So that's a decent amount of inventory. So I think that their plan is, I think they wanted to get to like 300 communities, active communities.
Yeah. They've got 226 now.
Yep. Yeah. The goal is to get to 300 by next year or so. So that's a pretty solid goal. So they're going to have to continue pretty aggressively adding to that land inventory to be sustainable at this higher community target that they have.
Yeah, exactly. And, that's an interesting thing too, is because they're having to sort of accelerate, but they also you have to, with the home builders, it's sort of like you have to put your foot on the gas, but also have your foot like hovering over the brake at the same time, just in case. And I think that's one of the things that we're just seeing all of these companies kind of wrestle with, is like, okay, what are we going to do with the cash that we've got right now? Are we going to buy more lots? Are we going to buy more options? Are we going to buy back stock? Are we going to, firm up our balance sheet? What are we going to do in order to position ourselves? Because it's going to change at some point.
Well, and there's the risk. I want to just kind of bluntly state what the risk is, right? Because we talked about the risk with land, right? The risk is if you buy land, you've paid for it, or in most of their cases, you've taken on debt. So you're servicing the debt to cover that land for multiple years so you're sitting on an asset for multiple years before you ever develop it, right? And if you have too much land when the cycle turns, you have land that you're still having to pay for that now you can't, economically, it doesn't make sense to develop, or you can't develop as much, right? So, but there is one thing worse than having too much land when the cycle turns, and that's having too many houses when the cycle turns, right? So that's kind of the point you were getting at there, is they have to throttle that capital investment in building more properties to make sure you don't end up with too many properties in the wrong market, or too many homes that are built in an area where the demand is weakening, or the market turns, right? The cycle turns, interest rates go up, something happens, whatever the thing is that turns off the music. You don't want to have too much of a thing that you now can no longer get enough money to cover the expense of.
Right. Because most of these companies were around during the great financial crisis, and during the time period when they were building, out like Southern California, like out in Lancaster and Palmdale, or, out in Florida, or outside of Vegas, or, the exurbs of Phoenix. These home builders went through that experience of all of a sudden realizing that nobody wanted the houses where they were building, and there was, the foreclosure crisis really sort of hit those newer communities to some extent a little harder than the rest of the country. And so they have that memory in their minds when they're thinking about this, how not to be left holding the bag, even though it's a completely different situation now than we're dealing with then.
Yeah, I think that's a key thing, right? It is very, very different, because again, we're paying the piper now for the decade after that, where we were not developing enough housing to meet the consistent long-term demand. There's another thing too. Two things I want to touch on about Meritage before we move on that I think are important. Number one, another part of their year-over-year order decrease that's important is you have to remember that period of time at the end of the first quarter and then the beginning of the second quarter where things kind of stopped, right? Where there was a period of time where there were no orders. And then the second quarter, things, particularly in May and June, things went kind of bananas. And there was a lot of business that didn't happen late in the first quarter that happened in the second quarter. And Meritage second quarter last year was absolutely enormous. It was gigantic growth. So there's a little bit of that, kind of lapping a tough comp period at play here. But, I don't think there's any trouble here. And I don't think this is a sign of some sort of a cyclical, shift, but there are some pressures, right, going on with rising prices. You look at how much more their order book is showing the average cost, and they're selling a higher percentage of starter homes now than they did even, a year ago. Those are real pressures. And at some point it's going to either affect the company's bottom line, or it's going to slow its pace of sales. The last thing I wanted to mention too is, Meritage CEO Steve Hilton stepped down as CEO, retired as CEO, I think at the beginning of the year. But one thing I've noticed, he's still executive chairman, non-executive. He's still on the board. And he's still pretty involved because he's been on their earnings calls, right? So he's still involved strategically with leading the company's, not in the day-to-day operation, but so I think that's positive, right? I think it's positive because he's been such a guiding hand for the company, and it's good to see him still being involved.
What do you think about other avenues that Meritage has? One of the things that I'm worried about is that they're still mostly focused on sort of directly building for individual clients. They haven't really announced any deals that I'm aware of with, build to rent or things like that, like Pulte Group is doing with Invitation Homes. Is that a concern at all for you?
It's not, just because I think there is so much pent up demand for starter housing, and the market's so undersupplied. And on the grand scheme, they're a top 10 home builder, but the difference between like the top 3 and the bottom 7 of that top 10 is pretty significant, right? In terms of the scale of their building. Like, D.R. Horton has 500,000 homes in it, 500,000 lots in its inventory. Mm-hmm. Meritage has 63,000, right? So there is such a big difference. And because this is such that starter home is so much the underserved part of the market, I think even if we do see a shift, the worst case scenario is an Invitation Homes or a private equity group buys a community, right? Because I can promise, even though it's not part of their strategy, they're getting calls, right? And they're having conversations.
I would assume so, yeah.
Right. Even though it's not a identified part of their strategy. I think being kind of a pure play is smart, because you've got a few that are pure plays in this. And I think there's going to be demand, and it's not going to be I don't think it's a weakness to not have that part of their clear strategy, their selling strategy.
Well, that is the thing that when we're talking about housing booms and housing bubbles, that is the thing that is making all the difference this time in terms of what could happen with home builders, and why I think home builders don't have to be as worried about that is because there is that backstop. We've got billions of dollars in capital from public companies like Invitation Homes, but also from private funds. I think I see the amount of money going into these private funds that are buying single family residences at scale is just enormous. I've never seen anything like it. There's billions of dollars going into this space, not just coming from the US. There's companies from Canada coming to invest in the US. There's a lot of desire for institutional investors to hold large scale single family rentals at a level that really hasn't existed before. I think Invitation Homes and Blackstone kind of showed that this was possible for institutional investors. And then in the past decade, we've seen that become really a developing asset class. And so that for a lot of these home builders, that would be the backstop if something does happen and there isn't that demand from the individual buyer anymore. Margins will shift. It'll be a different price at the end, but those homes probably aren't going to just sit there the way they might have in a different type of cycle.
Yeah, I think that's the case. I also think that it's a necessary strategy shift for a lot of private equity, a lot of institutional that has historically focused more on maybe office buildings or other commercial, because there's a lot of uncertainty there about how stable the cash flows can be from a lot of those assets in certain markets, because we don't know what the next 5 years is going to bring with the total viability for that space. I think it's still going to be huge and it's going to be important, but we know housing is going to be important, right? We know there's going to be demand there. So I think there's a little bit of a shift kind of the risk profile that's behind that transition. We've seen the acceleration over the past year And I think a lot of it is just the calculus of, okay, we have a big endowment. We need something that's going to protect our capital and generate whatever our cash on cash rate of return metric minimum is. And do you buy what looks like an undervalued office building, or do you buy single family residential housing? I mean, I think it's pretty obvious where you can predict steady cash flows, and where, the calculus might change. Right. So
I think part of that too is that the business model had to evolve. It was,
Right.
I think that was part of what the sort of kind of genius of what Invitation Homes did, is they showed what the system could look like. Because I think what everybody saw was, well, why would I possibly want to have to manage, 12,000 homes? That sounds like
Right.
sounds like a nightmare.
Right.
But I think that they showed that it's possible to put in a system that can work, and then you can get those great returns at scale.
Yeah, because that's easy to think, right? It's one thing to manage an apartment building, and it's another thing to manage housing or single family housing. It's
Exactly.
everything's harder. It costs more. You have more land to deal with. Yeah, it's a lot less uniformity, right? So all of those factors, but they've shown you can do it. So yeah, and there's money to be made. There's obviously money to be made there.
So let's continue to talk a little bit about, we've got about 15 minutes left. I wanted to talk about kind of how people can think about choosing home builders, because we've got, we've talked about Meritage, we've mentioned LGI, NVR is another one that I know you and I both like.
Mm-hmm.
The two biggies are probably D.R. Horton and Lennar. Do you think it's better do you look at the smaller home builders that are a little more nimble, or what do you think of owning the two giants in the space?
For me, this is very much a personal preference thing. I prefer the smaller home builders myself, because I think their opportunity in this market, let's be realistic, even with the massive shortage of housing that we have, the percentage rate of growth is pretty low, right? It's not super duper high, just because we already have, a couple hundred years, really 75 or 90 years or so of like modern homes, right? So we have a pretty large existing stock. So even though we are far undersupplied, the rate of growth is not enormous. And for me as a growth investor targeting that growth, I tend to prefer the smaller home builders. On this list, certainly, Meritage and LGI, because not only are they smaller, so their ability to take more market share as they grow, I think is good, but because they have the strategies that are kind of focused on where there's the obvious substantial shortage, and that's in the starter properties. But I don't think that means you should look past, a Lennar or a Horton. I think between the two, I tend to prefer Horton. Great margins. They've been doing this for a long time. That we mentioned 4-star, whatever happens with that relationship, it means that as a big home builder, it's really important to manage that pipeline, right? The orders of magnitude go up. The ability, the importance of managing that pipeline of land becomes even more important. And having a related party that's also a separate entity managing that is really helpful in terms of that. But I do tend to think, as an investor, I think your chance of better outsized returns lies with buying the smaller companies that are focused on where the need is the strongest, so long as they manage their balance sheets well. Right. And that's the key. For example, looking at LGI versus Meritage is still larger. They still sell more homes. Their average sales price is significantly higher, so they generate a lot more revenues. Great margin profile, so their earnings are larger. But LGI Homes actually has a larger inventory of properties now. On one hand, that's great if the growth story continues unabated, but the risk is if there's a downturn of some sort, even a short period of downturn, which is probably what my expectation over the next decade is, we might have one or two little blips on the radar. Depending on the timing of those blips on the radar, leverage can completely undermine a successful business, right? And hurt shareholders hard. So I think that's the risk you have to manage. And I think a basket approach is probably the safest way to invest in this sector. You know, own 4 or 5 of the top home builders, and I think you can position yourself well, and you don't have that single factor risk of an LGI that gets off a little ahead, you know, out over its skis. And as the shareholder, you take the brunt, right?
Right. Yeah, I think that's true, especially because you do watch these home builders pursue slightly different strategies.
Mm-hmm.
I
Mm-hmm.
mean, we saw it's interesting because I think a lot of them have sort of coalesced around a couple of different strategies. You know, we talked about some of them like leaving a little bit, leaving the West, going to the Sun Belt. It seems like a lot of them are doing that. A lot of them are pursuing entry level. One of the things I do like about Lennar is I do feel like they are really kind of innovative. So they've got their Lennar Ventures, which ends up being sort of like it's where they invest in a bunch of different things. They invested in Latch early on,
Right.
but I think you've got some innovation there. I also like what both Lennar and DR Horton are doing in terms of floor plans with multi-generational. I feel like multi-generational is going to be something that's huge. I think that it's really, when we talk about aging in place, and the bottom line is baby boomers are more active than the previous generation, but at some point aging does catch up with all of us. And
Absolutely.
I think that we're going to see, because home prices are so high, we are going to see more families moving in together, which is a sort of one of the things I find fascinating, because it's a throwback to the way things used to be, sort of, you know,
and the way things still are in a
50s.
lot of the rest of the world besides the
Exactly.
US.
Yeah. And
And it gets a lot easier with you think about the remote work movement. You know, all of a sudden things like that become a lot easier to facilitate.
Yeah, that is a really good point as well, because one of the things that we saw during this remote work is it has disproportionately impacted women with, you know, caregiving obligations and things like that. And one of the solutions sometimes can be to move your parents in. You know, I've seen a lot of my friends have done that, and it actually kind of works out pretty well for all concerned.
Yeah, depends on the grandparents, right?
Yeah, your mileage may vary.
Yeah, exactly. So just real quick, JP may be full. Yeah, that was DH Horton. 24% of lots are owned and the rest are through purchase contracts. Just saw that in here. But I just think it's such an interesting time right now. And you think at the rates of growth some of these companies have reported, it's crazy, right? I mean, Horton, revenue is up, what's almost 80%. How much did Lennar grow its sales? 30%. New orders were up 32%. I mean, these are big companies.
Yeah.
22% revenue growth for Lennar. You know, it's a company that does $25 billion a year.
Yeah, absolutely. So let's talk a little bit about, when you look at earnings, what you should be looking for home builders, just because it's slightly different than.
Yep.
So we talked about lots. You want to see, you want to find out how many lots they have. You want to find out that ratio of owned to optioned. You also want to see where they're building. A lot of the home builders, when they do their earnings call, they also do a nice investor deck where you can look at, they do little pie charts and little graphs where you can see where they're building now, where they're building next. You want to look at community size and whether those communities, what the inventory is, how they're planning to expand communities. Are they planning to start new communities, or are they still filling up homes in existing communities? You want to hear what they have to say about commodities. I mean, everyone is going to talk about the price of lumber and things like that, but you want to hear what their strategy is. On the earnings call, some of them talked about ordering things in advance and how they're using that as a strategy. You want to look at net sales orders, and you also want to look at absorption rate, which is how much of that inventory is getting taken up, and how many homes they have on backlog as well.
Yeah, I think for me, the bigger thing is just like with any other business or industry, you want to really kind of focus on the trends, and do the trends on the earnings statement and the trends on the cash flow statement and the balance sheet match up with what management is telling you is the company strategy, right? So, and if there is a deviation, then does the explanation that management's giving you make sense? Or are they just trying to move the goalposts to where the ball's going, to try to get that kick through the goal, even though it's not the original goal or strategy? So I think that's really, really important. And to me, the big one is, in addition to those things, is really understanding the balance sheet, really understanding like working capital, which is current assets minus current liabilities. Do they have enough working capital to easily get through periods where there's a downturn, right? The demand shifts quickly, without having to take on more debt. In other words, relying on the generosity of others, right? You want companies that don't have to rely on the generosity of others to keep their doors open. And then also think about with the debts, understanding if they have like secured or unsecured notes, right? When do they mature? What's the waterfall of those debts? Like, do they have a lot that's coming up at a certain period of time, which means you're going to have to raise a lot of capital or new debt to retire that old debt? And what are the implications? Are interest rates going up? And that means that all of a sudden their debt service is going to get a lot more expensive in 2 or 3 years, right? Thinking about all of those things is really important because these are cyclical businesses that do have leveraged assets that are harder to monetize when they need to monetize them the most, which is when there's a downturn.
Exactly. And that service is really important because as we started, when we started talking about this, there's a lot of cash right now. And so some of these companies are using this opportunity to take a look at what their debt is for the future and trying to figure out how they can position themselves a little better, maybe paying off some things now, maybe positioning things a little further out. So it's not hitting, in the next 2 to 3 years, but is hitting, further out. So I think there's a lot of that strategy kind of with debt definitely plays into what they do.
Yeah. We only have a few minutes left here. I want to talk about valuations before we wrap. So what do you have next before I go there?
Let's go for it.
Sweet. Okay. So I was talking about it earlier about, the valuations that we're seeing on a price to earnings, on a price to earnings perspective. And I'm going to do a screen share here real quick if I can. I know we have the technology. It's just whether I can hit the button right to do it is another question. Okay, here we go. So all right, so this is PE ratio, price to earnings ratio, going back about 5 years. And I want to say this too. I'm not going to show it on the chart, but I'm just going to say it. A lot of these stocks, the stock price for a lot of these is near all-time highs, right? It's near all-time highs, right? And then at the same time, right? So this little period here, this was the coronavirus crash when everything was cheap, right? By and large, a lot of these companies are trading for similar or even lower valuations than any time over the past 5 years. As a group, I think home builders are cheap. I really do. I think they're cheap. I think this is going to be a mega cycle. I really do. I think this is a super cycle for housing over the next decade. I think that we're going to see strong results. We're going to see very strong growth over the next 3 or 4 years, and then it's going to moderate and then still be pretty steady. There's going to be some ups and downs along the way. And for me, I view a lot of these as worthy of holding long-term, with the willingness to ride out some tough periods and the willingness to look at those tough periods as opportunity to add, because the cycle change is temporary. And if it's a good, durable business, that temporary cycle that sends the stock down is a great opportunity to buy, right? It's a great opportunity to buy. So that's
absolutely. Yeah.
That's the story.
We've got a question from Kelly that I want to address about green building in general, saying there's so much interest in tiny homes and green built homes. I wish there were more interest in tiny homes and
Yeah.
green built homes. I feel like that's a thing that gets more press than actual demand from what I've seen. I would say that all of these home builders to some extent have addressed some of this, some more than others. But in terms of tiny homes, there isn't as much demand, I think, yet. I think part of that is changing. For example, the state of Maine just changed the rules so that tiny homes and tiny homes are seen. You can basically build them the same as you can single family homes. Like they changed the square footage requirements. I feel like that's going to happen in more places, but I don't know if there's any specific green builders that I can think of.
Yeah. So I think what a couple things you've seen. So Meritage Homes definitely has their Live Now. I can't remember exactly what it's called now, but they have like part of their entry level offering are homes that are really focused on energy efficiency. They have
Right.
a deal with a solar company. In California, basically new homes have to have solar.
Yeah,
Yeah. So,
no
so I
choice.
think you're going to see maybe a regulatory shift that kind of focuses that. Um, but I also think it's something that younger buyers are starting to demand more. So you're seeing some of these companies start to come up with strategies that are more focused on it. But the reality is that, you know, virgin timber is the cheapest way to build a house, right? To build a house reliably and repeat it. There has to be a technology answer to green housing, and there's technology that's coming there, but it's just a lot of it's expensive, and that's already a problem with housing, right? It's expensive, so
Yeah,
it's a challenge.
there aren't really any. There hasn't been enough focus, in my opinion, on construction waste. So I think that to some extent, the home builders don't have to worry about it until they have to worry about it.
Right.
Wanted to mention this question that we got. I'm bothered by cookie cutter homes with inferior quality. I wonder if what these communities will look like in the future. It seems homes are larger and built to code, but not to the spirit of those standards.
I would say I think a lot of the modern builders are building better homes than were built in the 80s and early 90s. I really believe
Yeah,
that's the case.
definitely agree with that.
So I think it's better because like you look at the existing stock, it's coming up on 38 years old on average, and there's a lot of people that have those homes that were built in the 80s that are spending a lot of money at Home Depot to bring them up to standard. I think we're going to have a little bit better durability from the new stock.
Well, and I also think to some extent the mergers and acquisitions that we've seen inside home building is good news for that, because I think some of that was smaller fly by night home builders. My mother lives in a community in Florida. Every house on her street has had to have their plumbing redone. Just, and they're all built during the 80s from one of those smaller home builders. So there is that advantage to being at scale. Uh, Last question from FI Father. In your opinion, are home builders a bedrock, buy it and forget it part of a portfolio, or a cyclical sector that requires a bit of vigilance?
Yeah, I think the latter. Um, just again, because the cycle can turn, because they're more leveraged
Yeah.
businesses. Um, so there's more risk. I don't think they're like a trade on kind of investment, but I think you certainly can do better if you find the ones that are well run, of course, obviously, and the ones that have those strong balance sheets. And then you look for opportunities when the cycle turns to buy more. And you have to be very much more thoughtful about what is your financial goal. And as you get closer to that financial goal, just like with any stock, you're exposed to the volatility of
Right.
something large happening that can send prices down 10, 20, 30% or more very quickly. I think the closer you get to your financial goal, the more cognizant you have to be to exposing yourself to that capital, to losing capital permanently by owning home builders at the wrong time. So that's my only caveat there, is I think you have to buy them with a 10-year horizon. And then the closer you get to that 10-year, you have to be more willing to cut bait to avoid that risk of the downside, right? But base it more on your financial goals, and then you can build a schedule that makes sense on owning those businesses over that period.
Well, I also think the other thing that is good perhaps about owning home builders is that you'll know because the media covers the market so much is that, as if you're noticing housing at all, you'll start to hear about things. So it does take a little bit of awareness, but it also isn't something that you necessarily have to focus too much on because you can sort of see the larger trends at work.
Yeah. You don't have to read every, 10Q from beginning to end and read every earnings call from beginning to end and have your finger on the trigger to hit the sell button, every time the National Association of Realtors drops their housing report every month. You don't have to do that.
Yeah.
I want to be clear. You don't need to, that's not healthy. If you're interested in it and you love it, like we do, yeah, totally. But don't feel like you have to be on a hair trigger with home builders. You just need to stay aware, to Deidre's point.
Excellent. All right. Well, we
right.
are at 3:00.
I think we've got a recording here, a replay from, I think, is this Tom? Is this who's on this one? So this is the Bryans and John Feroldi, the hunt for 10X stocks, right? So got that lined up for the next hour. Deidre, this was fun. Thanks for having me on.
Thank you. Always a good time.
All right. See you soon.